Professor Wong, Professor Tai, distinguished guests, ladies and gentlemen, welcome to the Conference on the Future of Hong Kong Economy 2024. We are honored to have you all here today as we embark on this insightful event jointly organized by HKU Business School and Hong Kong Institute of Economics and Business Strategy.
Before we proceed, we would like to express our heartfelt gratitude to our esteemed sponsors who have made this conference possible. A special thank you goes to our diamond patron, Bank of Communications Hong Kong, our gold patron, Industrial and Commercial Bank of China Asia Limited, and our silver patron, New World Development.
Now, allow me to introduce your MCs for today's event. The gentleman standing beside me is Sunny. Sunny is a BBA student majoring in International Business and Global Management at the University of Hong Kong.
And joining me on stage is the talented Karine. Karine is a BBA student specializing in accounting and finance, also from the University of Hong Kong. Now, let us commence this remarkable event on the future of Hong Kong's economy.
Last week, HKU Business School unveiled a significant publication, the Hong Kong Economic Policy Green Paper 2024. I'm sure each one of you already has a copy in your possession. This green paper serves as a valuable resource, presenting extensive research findings and insights into the future of our city's economy. It specifically emphasizes policy analysis and reform recommendations across various sectors.
Building upon the momentum of this publication, today's conference aimed to delve into a wide array of critical issues surrounding economic development and government policies in Hong Kong. Moreover, it provides an ideal platform to foster meaningful discussions among industry experts from both the business and community sectors.
Without further delay, may we invite Professor Richard Wong, Provost and Deputy Vice-Chancellor of Hong Kong U, and Director of Hong Kong Institute of Economics and Business Strategy to deliver welcoming remarks. Professor Wong, please.
Good morning, distinguished guests, ladies and gentlemen. It gives me great pleasure to join you all here today at the Conference on the Future of the Hong Kong Economy. First, let me thank each of our extraordinary speakers and leaders for joining this conference. I hope you are looking forward to the discussions as much as I am. This is the third year of HKU Business School in publishing the Hong Kong Economic Policy Green Paper and organizing this annual conference. The Green Paper represents the concerted efforts of multidisciplinary research and analysis of the challenges and opportunities facing Hong Kong's economy. While the conference is organized as a platform for discussion and sharing valuable insights on the diverse economic developments of Hong Kong and the region in the long term. Building upon the success of the past 2 years, when on one occasion COVID was still raging through our city and we could not drink water because it was not allowed to be served. This occasion, the third, is a great relief and, shall we say, rejoicing as well. The objective of this conference is to serve as a platform for discussion and sharing of valuable insights on the diverse economic development of Hong Kong and the region in the long run. Building upon the success of the previous 2 occasions, we have once again brought together like-minded scholars from HKU Business School and other HKU faculties, as well as renowned experts from across the globe to collaborate and facilitate vibrant dialogue and intellectual exchanges with policymakers, business leaders, and respected community luminaries. As a highly open economy, Hong Kong's economy is inherently intertwined with global developments. It is a fundamental truth that when the world prospers, so does Hong Kong, and conversely, when the world faces challenges, Hong Kong's prosperity will also be affected. This interdependence has been evident throughout the past few decades, particularly with China's reform and opening up policies, and amidst intensifying geopolitical tension, increasing uncertainty, and economic landscape, and advancing development of disruptive technology. Hong Kong is now at a critical juncture. Furthermore, it is crucial for us to look beyond the immediate concerns of geopolitical dynamics and post-pandemic economic recovery. We should also consider the long-lasting impacts of events as far back as the 2008 global financial crisis and, of course, the 1997 Asian Financial Conference, with its profound effects still not entirely completely dissipated. Because of the long lags that operate through path-dependent, in practice, effects and institutional and regulatory rigidities. The global economy is once again held hostage, and we have yet to see the dawning of Hong Kong's economy, hopefully this year, if not too far from now. Given these circumstances, it is more important than ever to come together and identify and agree a way forward for Hong Kong's economy. Looking ahead, while uncertainties may cloud the horizon, we remain confident in Hong Kong's people and businesses and our inherent vitality as an international hub in sectors such as trade and finance, logistics and transportation, innovation and technology, culture and creativity. By embracing resilience, creativity, and collaboration, we can navigate the challenges ahead, unlock new opportunities, and pave the way for a prosperous future for Hong Kong and its people. On behalf of HKU Business School, I would like to extend my heartfelt gratitude to all our sponsors and supporters, especially the Bank of Communications, the Industrial Commercial Bank of China Asia, New World Development Company, and all other organizations for the generous support and participation in our event. Your contribution has made this conference possible, and we are truly grateful. Once again, I would like to thank all of our wonderful speakers for sharing their time and insights with us today, and I wish everyone a healthy and rewarding 2024. Thank you very much.
Thank you, Professor Wong. Please be seated. May we now invite Professor Hongbin Cai, Dean of HKU Business School and Chair of Economics, to say a few words.
Distinguished guests, ladies and gentlemen, good morning. So excited to see all of you to attend this conference on the future of Hong Kong economy. As Richard just said, this is the third time we organize this conference. This is the third time we released the green paper. Now, we get quite a lot of attention from the release of the newspaper. One of the things I think is related to Hang Seng Index keep on dropping, right? Last year, it dropped below 16,000. Hopefully, it will stop dropping from today on. So, but I think this is a time where everyone is concerned about Hong Kong economy, and everyone wants to see what's the solution, what's the light out of the tunnel. And I think this is the time where we really think that policy discussions, policy debates guided by rigorous academic research is very much needed in Hong Kong, and that's why we're organizing this conference, we're releasing this research report. And so today I think we have a very exciting program, starting with the keynote speech by Professor Joe Stiglitz. Joe needs no introduction for anyone who study economics. And I think, is Joe online already? Because there was some technical issue, as many economists, we're not very good at all this high-tech stuff. So, but I think he's online now, right? So Joe, it's basically a prodigy in economics, got PhD from MIT when he was 24. Hi, Joe.
Hi.
Good evening. Thank you so much for joining us.
I wish I could be there in person.
Yeah, we wish that we'll see you soon too. You have some old friends in the audience as well. We'll say hi to you later on. But thank you so much for joining us. I was just telling everyone, I think, everyone knows of you, and then everyone who studied economics has, studied so much of your papers, past-breaking research. As graduate students, we struggle to understand all your models. And so at a very young age, Joe got the Nobel Prize. 2001, he got Nobel Prize. He's also extremely influential in a policy circle. I used to be a senior vice president and then a chief economist for the World Bank, and also a chairman of the Council of Economic Advisors for the US. And among many, many things, he continued to do research, write, and then public policy on inequality, on globalization, now on big tech, tech dominance, and then antitrust, any topic that is relevant and important nowadays around the world. Without further ado, Joe, I will turn to you. Thank you very much again. We're very much looking forward to hear your thoughts. Thank you.
Well, thank you. And as I said, I wish I could have been there, and I want to congratulate you on your economic policy green paper, which I found very interesting. What I'm going to be talking about is the year ahead and looking at a particular set of issues. I think the year ahead is going to be a very tumultuous year globally. We're very aware of it in the United States. We have a very big election, which will almost surely make a very big difference and not be a very quiet election. What I'm going to do is try to focus on a few of the major changes that have occurred in what is now being referred to as the post-pandemic global economy. And there are three things in particular, three changes I wanted to focus on. The new geopolitics, the new politics domestically, and the new economic policies. On the geopolitics, I'm going to talk about the increasing split, how might it evolve, what may be the consequences. In terms of the new politics, there are two issues I want to focus on. The new concerns over market power in general and of the market power of big tech in particular. I'm going to talk about the lurch to the right in many countries and the potential consequences, the reasons for this. And in terms of the new economic policies, there are two major changes. One, we're moving from an era of near zero interest rates that we've been in since the global financial crisis of 2008 to a new era of high interest rates. I think it's going to be, we're going to have higher interest rates for as far as the eye can see. But there's another major change, which is sometimes encapsulated in terms of the end of neoliberalism, the set of ideas that were critical in thinking about global economic policies, the formation of the WTO, the rules governing the IMF, all those have changed, and some very markedly, and I'll talk about one or two examples. Now, while these represent very big changes in the global economy, there are some old issues that remain and in many ways have gotten worse. And two of them I want to call attention to. One of them is inequalities both within countries and between countries. The Hong Kong Economic Policy Green Paper that you prepared talked about inequalities within China, within Hong Kong that have been growing, but there are also these inequalities that have been growing within the United States and many other countries. The pandemic itself exposed and exacerbated these inequalities, especially with respect to health. And the other major issue that we cannot ignore is climate change. We are seeing the consequences of it. We're living with it, but we have not yet had the resolve to deal with it. And of course, all these issues are intertwined in ways that I hope some of my discussion is going to make clear. So let me deal with these in somewhat reverse order. The one that is staring us in the face is that we've moved from the era of near zero interest rates to high interest rates. This was done in response to the unprecedented post-pandemic inflation. But in my judgment, the central banks made a very big mistake in diagnosis. They had a knee-jerk reaction. They saw the increase in inflation. They were taught sometimes in graduate schools and not the right economic programs, but they were taught when inflation increases, you increase the interest rates regardless of the cause. But in fact, it turns out that if the cause is not excess aggregate demand, then raising interest rates may be counterproductive. It's the antithesis of what you want to do. Well, I believe it's now clear that inflation was driven by pandemic and war-related, the Ukrainian war, supply side interruptions and demand shifts. There was a major shifts in demand. For instance, in the United States, we went from purchasing services to purchasing goods. Increase in demand of goods was 10–15%, huge. People wanted changed where they wanted to live. Housing prices went up in the places where people wanted to live, but they didn't go down very much in the places where people didn't want to live. And so the average price went up, but it wasn't a problem of excess aggregate demand as normally defined. Take the case of housing. Because of the pandemic, America lost over 1 million people died. And of course, the major determinant of the demand for housing is the number of people. In terms of the aggregate, the demand for housing should have gone down. And that should have lowered prices. But it went just the opposite way. Prices went up. But that was because of the asymmetry in responses to excess demand in those places where there's a shortage and excess supply in other places. There were some other aspects that made this a unique and complex event. Because of the interruption of supply chains, supply became very inelastic. And that meant that in many sectors of the economy, there was the opportunity of firms with capacity to exercise market power. And so you saw the exercise of market power. Markups went up more in those sectors of the economy where there was more market power. And so the result was that prices went up much more rapidly than can be accountable by excess demand. In fact, I did a study looking very carefully at what was happening to aggregate demand, sum of consumption, investment, government expenditures, and net exports in the United States. And it was very clear when you looked at the numbers that, in fact, aggregate demand was almost consistently below potential supply. And so it was not a problem of excess aggregate demand. But when you increase the interest rate, what that's supposed to do is reduce aggregate demand, but that wasn't the problem. When you increase interest rates, it makes it more difficult to address the problems of supply. Raise interest rates doesn't solve the problems of shortage of oil, doesn't solve the problem shortage of chips and automobiles, which was one of the major sources of inflation early on in the post-pandemic inflation. It doesn't solve the problem of shortage of food. And in the case of housing, it makes things even worse. Firms don't, developers aren't going to develop housing with the interest rates are as high as they are now. And so rather than having the market respond to the shortage, it made the shortages worse. So the central bankers, because they misunderstood things, actually made the problems worse. There's also a strand of research which shows that those firms with market power tend to raise prices even more in the presence of higher interest rates. So the central bank's policies have actually not helped matters. They made things worse. Now, the good news is that as I and many other people in the group to which I belong, who analyze these as a largely transitory phenomena that would eventually be corrected by the market is now in the process of correcting. And there's been major disinflation. The rate of inflation, that's what has come down. That's what we call disinflation. Not deflation, that's prices coming down, but disinflation. Some economists said that the only way we were going to get disinflation and rate inflation to come down was to have unemployment rise very high, well above 5%, 7%. For several years. Well, unemployment has been remaining around 4%, and the rate of inflation has come down. So those who said it was a problem of excess aggregate demand, largely for political reasons, because they wanted to blame Biden excess spending for the inflation, they've been proven wrong. They were obviously wrong if you look carefully at the timing and the nature of the inflation, but the disinflation has been, you might say, the final proof showing that that particular interpretation, which was very influential among central bankers, that was wrong. Of course, let me make it clear, we needed to normalize interest rates. Did not make sense to have interest rates at zero for so long. Zero is not the cost of capital, and it's important for us to normalize the interest rate. the question is, though, should the central banks have gone so far, so fast? And I think they have made a mistake. There are consequences. One consequence is there is a risk of a hard landing. And that's especially so in countries without the fiscal space and with less robust growth than the US. Actually, I think the US is going to manage, I hope this will, a soft landing. And the reason for this is that we're actually going through a period of very strong growth, partly caused by the infrastructure bill. We passed a green investment bill called IRA, Inflation Reduction Act, and we passed a CHIPS Act. So we passed three very major pieces of legislation, and that has provided some fiscal support, fiscal expansion to counteract the contractionary monetary policy. And so you might say two offsetting mistakes. We're spending more than we anticipated on the fiscal side, but we are more contractionary on the monetary side. But other countries don't have the capacity for running the magnitude of the deficits that we have, especially developing countries and emerging markets. And there's a lot of uncertainty because monetary policy acts with long and variable rates, variable impacts. And so we may not know the full impact of monetary policy for another year or more. Nonetheless, there's a broad consensus that 2024 is going to have slower global growth. That's where the IMF forecast is. It's going to be a weak year, weaker than last year. And there is a possibility of an increasingly large number of developing countries and emerging markets having debt crises. It will affect those in the countries enormously. If enough of them have these debt crises, it will have a global impact. But even in advanced countries, the high interest rates are having consequences. Those are especially severe because we've had this period of low interest rates for so long, and that has meant that companies and countries have gotten over indebted. Very early on in the tightening, there were major problems in the UK pension funds. Later on, here in the United States, we have problem with Silicon Valley Bank and the UK and several other banks in the United States. So this is the where we're going. There's going to be a global slowdown, and this global slowdown is going to be compounded because of weaknesses. This is what you probably know better than I do. Weaknesses, at least that we see from abroad in China, related to its property sector, the challenges posed by the new geopolitics that I'll come to in a few minutes, and a move away from export-led growth, its difficult post-pandemic recovery, its partial clampdown on at least part of its technology sector. And obviously, the global slowdown and the slowdown in China, the weaknesses in China, will have knock-on effects all over the world, but particularly in Asia and particularly in Hong Kong. Let me turn now to the second aspect that I mentioned, which is new economic policies, and in particular, the end of neoliberalism. The idea of neoliberalism was you just leave it to the markets. Some people think of these ideas associated with Milton Friedman. Some of them are very strong in Hong Kong, but they were strong globally. And I think within academia, there's increasing skepticism. My own work 40 years ago showed that Adam Smith was wrong, that the visible hand pursuit of self-interest did not lead, as if by an invisible hand, to societal well-being, that there were a whole set of very serious market failures, that there was therefore a role for government in both providing for public goods, regulating externalities, and intervening in a whole set of ways. The idea that excessive reliance on unfettered markets began to be questioned after the 2008 financial crisis and the emergence of the inequality crisis. But by 2016, protectionism was on the ascendancy, especially in the United States. But that was, some people thought that was a peculiarity of Trump, but it was continued with the Biden administration. And in particular, industrial policies are back in after being criticized for 40 years, including the US criticism of China's industrial policies. But even though the US policies are not well designed, they are seeming to have large effects. But the magnitude of the expenditures expected that the Inflation Reduction Act, we will be spending on industrial policies over $1 trillion, is putting other countries, especially in the developing world, at a disadvantage. Moreover, the US has backed off the WTO, and it has refused to allow the appointment of judges, and it's openly questioned the current rules-based trading system. It has said very explicitly that those rules are not being obeyed by China. And so it says, as long as that's true, it won't itself obey them. But there's something very peculiar, let me say. It refuses to let the judges in the WTO adjudicate those, whether China or not is obeying the rules, or whether the United States is obeying the rules. So that has to lead one to question the extent to which it really is committed to a rules-based system, or it doesn't feel actually more comfortable in a power-based system. Finally, let me come to the new politics. And there are two aspects I mentioned. The first is the new concerns over market power, and particularly market power of big tech. This is part of the broader concern about growth in market power. In the US economy, the evidence is very clear that competition is weaker. In fact, there's seemingly less dynamism in spite of the claim of being in a new era of innovation. We see that lack of dynamism in a marked slowdown in the increase in productivity, that the numbers show that what is called TFP, total factor productivity, the growth in that has come down dramatically over the last 20 years, 30 years. One of the problems is that the world economy with more market power is likely to be less innovative and dynamic. But that's only one aspect of big tech. There are actually multiple adverse effects of social media, including on the legacy media and its ability to play its role in the economy, called the fourth estate. Very important, in my mind, having a free press. One of the other consequences that there's been sustained high profits without high levels of investment. And they've worked hard to create new barriers to entry. And the high profits have contributed to one of America's strongest problems, inequality. Interestingly, in Europe, many of the problems that I've just outlined, they've begun to attack them through a series of acts called the Digital Services Act, the Digital Marketing Act. They've looked at both the social harms and the market power. My view is these were important initiatives going forward, but they're not strong enough. But in the US, almost nothing has been done. Not a surprise, the political power of the tech giants has stymied significant reform. But that has, in turn, has led to a world that is emerging that sometimes we refer to as the splinter net. How will the world work with three different standards in the digital space? Will there be a new era of digital protectionism? So there are lots of questions, and we can see where this is going. AI, which has gotten an enormous amount of attention in the United States and elsewhere, presents a new set of problems, a new set of questions. Will it replace labor, leading to more unemployment, lower wages, and increase inequality? And there are a new set of, I think it will, I think it's a major problem for our society. There's also a political battle that has opened up. AI, like Facebook and Google, has made use of the intellectual property of the media, the legacy media, and that has diverted profits from the legacy media to the big tech companies and the new ones, the new AI company. And that has led to a major billion-dollar suit from New York Times saying that you're stealing our property. Also related to, given rise to a whole set of ethical issues. Who is accountable for slander if AI attributes something to New York Times, which New York Times never said? Who is accountable? And the problem is, way back in 1995, the new media, the new tech, high tech, succeeded in gaining immunity from liability, which has led them to be less accountable than they should be. All this says that we're about to open up some major battles within our society. The other aspect of new politics that I'll just talk about very briefly is the lurch to the right. And there's a lot of debate about what is the reason for this. I think it's part of the economic malaise, the growing inequality, the failure of neoliberalism. It's given rise to populism. But the irony is that the populist agenda and the political leaders will likely make matters worse. So the worry for me is that will feed into more populism. There's a possibility it will give rise to a correction towards more normal politics, but I'm afraid that the real danger is it will reinforce the lurch to the right. Of course, how this plays out will differ markedly across different countries. In the United States, almost surely race and the almost surely futile pushback against what's been happening as the U.S. has become a much more multiracial, multi-ethnic society. Let me emphasize what is going on, particularly on the right, is a very anti-democratic movement. It's a minority seeks to impose its will on the majority. Finally, let me spend a few minutes of topic which are going to greatly affect a global trading center like Hong Kong, which is the increasing split. There are multiple forces, human rights, democracy, competition. Graham Allison has talked about the Thucydides draft, the Taiwan, China's support for Russia in the war in Ukraine, which is very, very important for most people in America. But we have this curious situation where there's still a high level of economic interdependence. A little while ago, U.S. talked about friendshoring. That was a vocabulary that got into U.S. into a lot of trouble. A leader of one of the major countries in Latin America came up to me and said, "Are we a friend or not? Are we part of friendshoring?" And the language has now changed, partly motivated by the way Europe has characterized it. The official language now is de-risking, diversification. But whatever the vocabulary, the consequence is clear that trade between China and the United States will likely go down. The growing view in the United States is that this delinking, de-risking, whatever you call it, will actually be not as costly as had previously been thought. And that's especially that kind of analysis, that it is not as costly, has grown as neoliberalism has gotten discredited. In other words, in the era of neoliberalism, trade was paramount. Now the view was that opening up free trade created a lot of our inequality and got us actually just a little bit of economic growth. So going forward, I anticipate over time, not just next year, there's likely to apply less trade, lower financial flows with adverse effects on enterprises like Hong Kong. Still, let me emphasize, even if we're in a world of splitting, there's a need for global cooperation to solve global problems, and most importantly, climate change and pandemics. And in these areas, particularly, cooperation is in everybody's interest. The US has the view that one can have fierce competition in other areas, be very tough in other areas, and get still strong cooperation on climate change. I hope that's true. There is real urgency on climate change. Let me be clear about that. I think China's 2060 target for carbon neutrality is not ambitious enough. The world is at risk. And I'm glad that under the Biden administration, stronger measures have been taken, but still not enough. We need to realize the high degree of interplay between different issues I talked about. For instance, as one example, the high interest rates make climate change investments more difficult unless special windows are opened up. And this is going to be especially important in the developing countries. So let me conclude. The failures of neoliberalism, pandemics, and wars have led us to enter into a really tumultuous era. which is quite different from the era of the Great Moderation that lasted from after the inflationary period in the 70s until 2008. So we had a quarter century of the Great Moderation. We're in an era where nothing can be taken for granted. There are new economics, new politics, new geoeconomics, new geopolitics. This is especially important for Hong Kong. Hong Kong will be buffeted by these changing global storms, winds, however you put it, and Hong Kong, as everywhere else, will face new challenges in navigating these very rough waters. Thank you, and I look forward to our panel discussion.
Thank you. Let's give a big round of applause to Professor Stiglitz for the insightful sharing. Professor Stiglitz, please stay in the line with us. We'll be back